I'm portfolio manager at Invesco Quantitative Strategies, and we manage a broad range of low volatility equity portfolios. And with the ever increasing importance of ESG, we analyzed the implications on the portfolio when we integrated strict ESG metrics. And with strict, I mean that the investable universe is reduced by 45 to 50% through a combination of exclusions of controversial business areas, but also applying best-in-class measures and measures to reduce the portfolio's carbon intensity. So we covered three things. So on the one hand, how does ESG change the portfolio characteristics? We then look at how to best implement it and finally show what's the measurable outcome. And you see a slide, and I'll touch on that in a moment. So let me start with the first point. So how does ESG change the portfolio characteristics? In a low volatility portfolio, you like utilities companies' stability that they provide. But when you focus on CO2 intensity, utilities should not be considered. The benefit of us being quant managers is that we focus not on specific companies, but on factor characteristics that help to identify outperforming companies. So attractive valuations, strong balance sheets, good earnings momentum, these sort of things. So we replace adverse ESG assets like the utilities with stocks that have similar factor characteristics, but from other sectors. So we manage to retain the same risk and return drivers and hence have the same performance profile. So how to best implement it? We are with this adding a third investment objective. So we have the low volatility focus as number one. We have the return enhancement objective, focusing on companies with good quality, momentum, and value characteristics, and now the ESG promotion. And these three objectives are not in sync. So low volatility may be dirty with some of the utilities we mentioned. Value stocks are higher risks, and with energy companies providing attractive value characteristics are dirty as well. So we need to avoid interfering effects. So what we do is that we process the objectives in separate steps. And the benefit for the client is that we can show how much of the risk budget is consumed by the ESG allocation. And we can also better attribute performance between our multi-factor model and our ESG positioning. So coming to the slide you see here, what's the measurable outcome? So what you see here is the portfolio has a reduced carbon intensity when you compare scope 1 and 2 emissions. And you see that the initial portfolio, the low volatility with the utilities overweight, had quite high CO2 emissions, and we improved that below the initial status quo and below the benchmark level. What we also looked at, which was not part of our analysis first, is the climate value at risk. So analyzing the cost for companies to align to a net zero economy. And we also realized that applying these metrics improves or reduces, better I should say, the climate value at risk of our portfolios versus to the starting point and versus the benchmark. So in conclusion, we found a smart way to promote ESG in our portfolios, reduce the carbon footprint while retaining the existing portfolio profiles that have proven to be beneficial.